This isn't just another policy headline. It's a potential liquidity event, and markets are now being forced to decide whether to price it as a growth impulse or as the beginning of a second inflation wave. President Trump's post-State of the Union economic tour, combined with the expected rollout of the so-called Big Beautiful Bill for 2026, introduces two immediate variables into the macro equation: no federal tax on tips and overtime, and a large-scale tax refund initiative aimed directly at middle-income households. On the surface, that sounds straightforward: more disposable income, stronger consumption, supportive for equities. But markets rarely stop at the surface. The real question is how this cash injection alters inflation expectations, rate assumptions, and the equity risk premium. Because once fiscal policy changes the flow of money into household checking accounts, everything else adjusts around it. Treasury markets moved first. Yields didn't simply react to the political rhetoric. They responded to what that rhetoric implies for aggregate demand. The short end of the curve began to firm modestly, reflecting the idea that if consumer cash flow accelerates into 2026, the Federal Reserve may need to maintain restrictive policy longer than previously discounted. The long end behaved more cautiously. There was no immediate disorderly sell-off. Instead, we saw a subtle steepening bias, not panic, but recognition that sustained fiscal stimulus complicates the disinflation narrative. And that's where this gets more complicated. If investors believe the refunds and overtime exemption represent a one-time pulse, long-term yields may remain contained. But if markets interpret this as structural fiscal expansion, term premium could quietly rebuild. That distinction matters, because equity valuations are highly sensitive to the long end, not just the policy rate. Now layer in the US dollar. Currency markets began to reprice modestly as well, not dramatically, but directionally. The dollar tends to respond to relative rate differentials and capital flows. If U.S. fiscal policy appears more expansionary than that of Europe or Asia, and if that expansion pressures rates higher, the dollar can firm as global capital rotates toward higher yields. But there's a second layer. If markets instead view this policy mix as inflationary and potentially destabilizing for fiscal balances, the dollar reaction becomes less linear. That's why the FX move has been measured. Traders are not chasing it, they are waiting for confirmation. And this is where investors need to be careful. The Federal Reserve now sits in a more delicate position. If disposable income rises sharply in early 2026, consumer spending will likely accelerate in the second quarter. Retail sales, travel bookings, discretionary services, these segments respond quickly to cash flow. But if spending reaccelerates before inflation has fully normalized, rate cut expectations could be pushed further out. Right now, the market is pricing a gradual easing cycle. This policy signal introduces asymmetry, not necessarily higher rates, but a higher probability that the Fed pauses longer than consensus expects. And equity markets are extremely sensitive to that probability distribution. Now translate this into sector dynamics. Consumer discretionary stocks are the first logical beneficiaries. Large retailers, e-commerce platforms, travel operators, companies with high exposure to middle-income households. If billions of dollars are injected into checking accounts, velocity matters, and consumer discretionary tends to experience that velocity quickly. But that's only part of the story. Margin sensitivity becomes critical. If increased spending allows companies to maintain pricing power while input costs remain stable, operating leverage improves. However, if renewed demand pressures labor costs or supply chains, margins compress even as revenue rises. Markets will begin modeling that almost immediately. Credit card processors and payment networks sit in an interesting position. Higher transaction volumes directly support revenue. The elasticity is strong. If overtime income rises and becomes untaxed, that incremental income may flow directly into higher card usage. That favors processors. But again, the second-order question is delinquencies. If fiscal expansion ultimately keeps rates elevated longer, financing costs remain higher for households carrying revolving balances. Volume up. Credit quality potentially pressured. Markets will try to reconcile both simultaneously. And the broader S&P 500? The index trades on growth expectations, earnings revisions, and discount rates. A fiscal impulse boosts forward earnings assumptions for cyclical sectors, But if discount rates drift higher alongside it, valuation multiples face resistance. That tension defines the next several sessions. Now here's where this gets more nuanced. Inflation expectations are not just about the CPI print. They are about psychology. If households anticipate meaningful tax refunds and permanent overtime exemptions, their spending behavior may adjust even before checks arrive. Businesses respond to that anticipation. Inventory decisions shift. Hiring plans adjust. Wage negotiations incorporate stronger demand assumptions. And once expectations move, they are harder to reverse. Markets understand this. That's why break-even inflation metrics are being watched closely, not spiking, but monitored. Because if inflation expectations drift even modestly higher, the Fed's flexibility narrows, and equity volatility tends to rise when policy flexibility narrows. Policy credibility is another layer. Investors will assess whether this fiscal plan is fully funded, partially offset, or deficit expanding. If markets interpret the package as materially widening the fiscal deficit, bond investors may demand incremental compensation. That is not a day-one reaction. It builds gradually, but it influences risk premium across assets. Global reaction risk also matters. If other major economies are in slower growth phases while the U.S. injects fiscal stimulus, capital flows may concentrate toward U.S. assets. That can support equities in the near term. However, if global inflation reaccelerates as a result of synchronized demand, commodity prices could firm. Energy, industrial metals, agriculture. Input cost pressures would then re-enter the conversation, and that would complicate the clean, consumer boost narrative. Because if this assumption is wrong, if inflation does not remain contained, then the market is not pricing a growth windfall. It is pricing another policy tightening cycle. Now let's think in scenarios. Scenario 1. The refunds and overtime exemptions create a temporary consumption spike without meaningfully altering inflation. In this case, retail and discretionary equities outperform into Q2 2026. Treasury yields remain range-bound. The Fed maintains a cautious but easing posture. Valuations hold. That is the constructive path. Scenario 2. Spending accelerates faster than supply can adjust. Inflation expectations drift higher. The Fed delays rate cuts. The yield curve steepens more noticeably. Equity multiples compress even as earnings estimates rise. Sector rotation becomes more violent. Cyclicals outperform defensives initially, then volatility increases as rates climb. Scenario 3. Markets question fiscal sustainability. Bond investors demand higher term premium. Long-end yields drift upward more persistently. The dollar firms sharply. Financial conditions tighten despite fiscal expansion. That paradox, stimulus coinciding with tighter financial conditions, would pressure equity indices broadly. None of these outcomes are predetermined, but probabilities are shifting, and markets trade probabilities. Now here's another subtle angle: business confidence. If corporate management teams interpret this policy as pro-growth and durable, capital expenditure could rise. Hiring could accelerate. That supports earnings beyond just consumer demand. But if executives view the policy as politically uncertain or temporary, they may treat the cash injection as transitory. In that case, they prioritize share buybacks over expansion. The market response differs significantly between those behaviors. Watch corporate commentary closely over the next several weeks. Listen to language around hiring plans and inventory commitments. Those signals matter more than the headlines. Also monitor small-cap equities. Smaller domestic companies are more sensitive to U.S. consumer income than multinational firms. If the Russell 2000 begins to outperform on sustained volume, it suggests investors believe the fiscal impulse is real and domestically powerful. If large-cap multinationals lead instead, the move may be more about rate expectations than demand. That distinction will emerge quickly. And here's where investors need discipline. Initial reactions often overshoot. Retail stocks can spike on anticipation. Payment processors can rally on volume assumptions. But if bond yields firm at the same time, valuations face cross-currents. Markets do not move in straight lines. They reprice in layers. Over the next 24 to 72 hours, focus less on political commentary and more on cross-asset confirmation. Are yields drifting higher in a disorderly way or stabilizing? Is the dollar strengthening on rate differential or weakening on fiscal concern? Are inflation break-evens edging up? Is volatility contained? Those indicators will tell you whether this is being treated as growth stimulus or inflation risk. And one final consideration: liquidity timing. If refunds and overtime exemptions begin influencing behavior before the physical cash distribution, the market may front-run the actual economic data by several quarters. Equities are forward-looking. By the time retail sales show acceleration, stocks may have already priced it. That's why the current debate is not about Q2 2026 data. It's about expectations forming today. So step back. This is a fiscal signal. It injects potential demand into the system, but it also interacts with inflation, rates, currency, and global capital flows. The first move was measured. The second move will depend on confirmation. If yields remain contained and inflation expectations stable, equities likely lean constructive. If rates climb persistently, the narrative changes. Markets are not reacting emotionally. They are recalibrating. And that recalibration may continue through the weekend rallies as more policy details emerge. So, watch the bond market first. Watch the dollar second. Then watch sector rotation, because those will tell you how seriously investors are taking the 2026 tax impulse. Not the headlines, not the speeches, the pricing. And pricing, as always, will lead the story.